So generally speaking, the dividend growth portfolio and M1 Finance that I run and operate, I generally don't like to change very much. Right now it has 20 holdings, and if you didn't know, last episode it had 21. And this brings me to the change that I just made. I sold out of a position, and it was a small 2% weighting in my portfolio, but we decided to sell out of SBUX. That's right. SBUX is one that we decided to sell out of, and I'm going to go over in this video why I decided to do so. They just came out with a huge presentation. They revealed their, quote, unparalleled reinvention plan just the other day, and on the back of this news I decided to sell out of the company. And it's not that this is a bad plan, it's not an EPS or revenue growth story that I think is going to be a failure, but instead it is one that I think is too optimistic, and I'll go over in this video their plans, outline some of the bullet points of this strategy. It's very long, we won't go through it all, but we'll go over some of the main bullet points. We'll talk about where Wall Street and other analysts are projecting this company will grow over the next few years, and as well as my take and some highlights from their most recent quarter and why we decided to sell out. If you haven't checked me out before, my name is Jordan. I'm a millennial investor. This is my portfolio balance since starting the portfolio in April of 2020 when I started my YouTube channel, and we've come a long way. This is my updated growth portfolio balance, and this is my performance and fidelity year over year, month over month. This is some of my cumulative returns versus the indexes, so you can take a look at these right here. Now, if you haven't seen already, this is the whole point why I make these videos, is to update these two portfolios. But if you want to check it out down below in the description for yourself, it is all in this little information down below. And if you want to get signed up with M1 Finance, which is where I'm sharing this information, you can get $10 for doing so, which 125 different subscribers have done so far. So without further ado, thank you so much for tuning in, and let's go ahead and get started with this reinvention plan that's on the main big headline of their investor relations page. It says SBUX enters new era of growth driven by unparalleled reinvention plan. And I read over the whole thing. And the main thing, I think, is this first little paragraph that I want to read over. This is the only part we're going to read over, and then I'll just give you the bullet points after that. SBUX unveils roadmap for accelerated EPS growth, which if you don't know is earnings per share, which is another way of saying it's bottom line earnings. Earnings per share is just profitability essentially. And this is what its earnings per share growth looks going back all the way to the 90s, and so far it's been pretty nice. Other than the 2020 pandemic, it's been doing quite well, and 2022 has been a little bit of a struggle. We've kind of flattened out. This long-term trajectory of growth is finally starting to flatten out, and we'll see whether or not that continues. But they say, quote, in connection with its reinvention plan, SBUX introduced a framework for accelerated earnings growth over the next 3 years, underpinned by enhanced comparable store sales growth, increased store count growth, continued margin expansion, and disciplined capital allocation. They said, quote, SBUX is a growth company, and our accelerated expansion is a direct reflection of the expected returns from our reinvention plan. By making strategic and highly targeted investments to drive value for partners, SBUX will also drive value for customers and shareholders, while managing costs, improving margins, and elevating the SBUX experience for all stakeholders. Now, they start talking from here about growth projections, and this is when I think things start to get maybe a little bit frothy, a little bit optimistic. Let's take a look. From fiscal 2023 to 2025, SBUX expects comparable store sales growth to be in the range of 7 to 9%, so high single digits on an annual basis, both globally and in the US, up from the previous range of 4 to 5%. They were projecting 4 to 5, now they're projecting 7 to 9 with this new plan. In China, SBUX expects outsized comparable store sales growth performance in fiscal 23 and fiscal 24. As the market laps the severe impact of COVID-related lockdowns, with growth normalizing in the new range of 4 to 6% in 25, an increase from the prior range of 2 to 4. So once again, raising those estimates from 2 to 4% growth to 4 to 6. The company's global store portfolio is expected to grow 7% annually on a net basis, up from the previous estimate of 6%. And it keeps going. We see lots of estimates like this, and then the one I really want to focus on, which is this last little sentence, and then we'll start talking about the bullet points. It says SBUX now expects global revenue growth in the range of 10 to 12% annually from fiscal 23 to 25, which represents an improvement from the company's previous range of 8 to 10%, driven by those priority investments, with non-GAAP EPS growth expected to be in the range of 15 to 20% annually through 2025 from the previous estimate of 10 to 12. So across the board, it doesn't matter what we're looking at. It doesn't matter if we're looking at top-line revenue growth, if we're looking at comparable stores growth, expanding the amount of stores, whether it's international, domestic, they are raising estimates across the board. Now, they talk about the reason why this is going to be so, and the bullet points of these reinvention plans. It's going to come from these little bullet points from, quote, centering the partner experience in a thriving network, unlocking experiential convenience for customers, investing in in-purpose built store concepts, delivering beverage innovation, expanding effortless digital convenience, accelerating Starbucks' leadership position in international, strength of its licensing model, acceleration of the digital Starbucks experience, purpose-driven growth agenda in China, long runaway for growth in at-home and ready-to-drink. They line out all these bullet points, and I read them all. And if you want to pause the video and if you want to read over this yourself, you're welcome to do so. But I think about this company's opportunity both internationally and domestic. And I know that this is exciting. When you look at these numbers, you see growth, top line, bottom line across the board is looking really good. And so when you look at this reinvention plan and everything's very optimistic, you might be saying to yourself, Jordan, all this good news just came out. They're reinventing the company. They're making things better. They're making it a better opportunity for shareholders. What's your reasoning for selling out? Well, this goes to where we're at today and what I think is actually going to happen. Now, the company is expected to lower EPS this year. Last year they did $3.24. Today they're expected to do $2.87 for the year of 2022. And so far this checks out. Let's go ahead and look at last year. They put up $3.50 for last year's number. Now, so far in 2022, the numbers that they put up so far are not that great compared to last year. They had some really profitable quarters going back to where they had even as high as $1.50 in EPS, and lately they've been putting up about 50 cents a quarter or so. Now, last quarter did go a little higher at 80, but so far throughout the first half of the year that they reported, they've done about, about $1.35. So if they were to double that, they'd be at about $2.70, which is right about what's being projected here. Maybe a little bit bigger in the fourth quarter, which they typically are a little bit higher at. So I think that this estimate at around $3 is pretty optimistic. It's pretty reasonable, I should say. Now, let's look at the share price. The company's share price currently trades at $91. Well, let's say that they do $3 in earnings per share. If you take 90, divide that by 3, this company trades at a PE of over 30. Now, the average PE in the market is currently, last time I checked, around 17. This company's trading at a 30. So even if they do hit these optimistic goals of 10 and 12% revenue growth and 15, 20% non-GAAP earnings per share growth, all this good stuff, that's great, but they need to grow at that level to make this valuation make sense, to grow at a 30 PE or better. Even their free cash flow. This is what's really important to me as an investor. We talked about the revenue and the earnings per share starting to flatten out, but what's really more important is the free cash flow, because that's actual cash you can use for the business. Notice that last quarter, just 4 months ago, this company actually produced a negative free cash flow number of almost $300 million. And then the most recent quarter was positive at $800 million, but is far below what was expected last year, consistently producing $1 billion or so in free cash flow. And this leads me to the most recent quarter. When they came out with these numbers, it said, quote, international comparable store sales growth decreased 18%, driven by a 15% decline in comparable transactions, a 4% decline in average ticket. China comparable store sales growth decreased 44%, driven by a 43% decline in comparable transactions and a 1% decline in average ticket. Their China sales decreased by almost half of their sales. 43% of that coming from people no longer showing up to the store, the amount of transactions, and then those that did show up typically spent about 1% less. So China is not in a healthy place, and it goes far beyond Starbucks. With their housing market, with their economy, things are rough. And guess what? The United States is not in the best position either, with interest rates going up and us potentially being in a deep, deep recession that could go well into 2023. And so when I look at these estimates for Starbucks and I see potential 10% revenue growth, 11% revenue growth, bottom line earnings growth, I don't think that that's going to happen. Even if I'm wrong, I look at the share price. Hopping back over here to M1 Finance and looking at the dividend growth portfolio, if I look over the last year or so, when I started adding this position, it was in May of this year. And we originally started the position in the 70s, okay? And at that time, I was wanting to buy in the 70s. I thought it would probably keep on going lower, and that's why I made it such a small position. I wanted to start buying in the 70s and then buy as it hopefully got lower into the 60s, the 50s, and so on. But now the company's already at 90 plus, and we sold out at $91 a share just yesterday, and this is not at a position where I want to keep buying the stock when there's so many other opportunities. If I go back to the dividend growth portfolio here, there's so many companies that are just tanked in share price. It doesn't matter if we look at Target, which is down year to date 29%. It doesn't matter if we look at any other company, like if we look at 3M, year to date this company is down 34%. And I can use this example for almost every single company in the portfolio. And so to take an opportunity like this to sell out of a company that is going up higher off of very, very long-term optimistic returns, I think now is the time to cash up and put that money into other positions. In the next video, I'll talk about where I put that money, which one of these holdings did I buy more of or multiple of them. So stay tuned for that. But thank you guys so much for watching. I appreciate you watching all the way to the end. Check out all the stuff down below in the description. Get signed up with M1 Finance to help support me and the channel. And without further ado, guys, I'll catch you guys next time.